Imagine for a second that you owe, I don't know, $7,000 on a car you can't even afford to trade in.
Yeah, that's a nightmare.
Right. And your neighborhood is completely gridlocked because a 1970s split-level home down the street somehow costs more than a brand-new build 3 counties over.
Which makes zero logical sense.
None. And then your employer is talking about putting private equity into your retirement account. And meanwhile, some guy on the internet just sold a piece of cardboard with a cartoon mouse on it for $16 million.
It honestly sounds like a surrealist financial fever dream.
It really does. But it's not a dream.
Yeah.
That is the exact economic reality we are standing in right now. Welcome to the deep dive. Okay, let's unpack this.
Let's do it.
Today's March 30, 2026. We're looking at a massive, and I mean massive, complex stack of reports, data sets, market analyses, covering everything from geopolitical flashpoints in the Middle East to real estate anomalies, the intricacies of the newest tax code, and the booming, borderline hallucinatory market for alternative assets.
Yeah, hallucinatory is a good word for it.
So the mission today is to understand the economics of shock and adaptation. We are going to track how a massive global event on the other side of the planet doesn't just stay there. It eventually trickles all the way down through the supply chain to reshape your wallet, your housing options, and, well, the very definition of how you plan to retire.
And that's the crucial thread we'll be pulling on today. We are going to connect the dots between global supply chains, government policy interventions, and ultimately consumer behavior.
Because it's all connected.
Exactly, because the macroeconomy isn't just, abstract lines on a chart that economists debate in a vacuum. It is the physical and financial environment in which we all have to survive, adapt, and make some really hard choices.
And I want you, listening right now, to keep something in mind as we navigate this. Ask yourself, how do you react when the cost of living suddenly spikes?
It's a great question to ask.
Right, like, do you instinctively hunker down and cut your spending to the bone? Do you look to the government for some kind of legislative relief? Or do you just throw your hands up, accept the chaos, and start taking bigger financial risks just to feel like you're keeping pace? Keep that question in your back pocket.
It's the perfect framing for what we're exploring, really, because to understand where the economy is going, we first have to understand what knocks it off its axis. We are looking at the mechanics of the economic shock.
Right. Where does it actually start?
Well, Tyler Goodspeed, he's the former acting chair of the White House Council of Economic Advisors. He just published a book called Recession: The Real Reasons Economies Shrink and What to Do About It. And his central thesis is that recessions are fundamentally unforecastable.
Which, I mean, that has to be a tough pill to swallow for Wall Street analysts who build their entire careers on predictive models.
It is, yeah. But his historical analysis makes a really compelling case. He argues that recessions aren't usually the result of a slow, predictable winding down of the business cycle. They are triggered by sudden, massive shocks that we simply cannot hedge against effectively.
Like out of nowhere.
Exactly. He points to the summer of 2008 as a prime example. Now, when we think of 2008, we immediately think of, what, subprime mortgages and Lehman Brothers, right?
Yeah, of course. Housing crash.
But Goodspeed notes that the highest price for energy since 1945 wasn't during the Arab oil embargo of the 70s. It was actually in June 2008 when Brent crude neared $150 a barrel.
Wait, right before the financial system collapsed, oil was at a historic peak.
Exactly. By the summer of 2008, the average American household was spending roughly $2,000 more per year just to fill up their gas tanks and heat their homes.
Wow.
And this hit at the exact moment their adjustable rate mortgages were resetting, which was adding another $800 or more a year in housing costs. So the energy shock catalyzed and deepened the housing shock.
It pushed them over the edge.
Precisely. Goodspeed also points to the 1960 recession, which was heavily driven by a massive, unexpected steel strike in 1959.
Because steel, like energy, is a foundational ingredient.
Yeah.
It has what economists call high linkages.
Yes, high linkages, meaning that a sector is deeply intertwined with almost every other part of the economy. When a foundational sector like energy or steel experiences a violent shock, the entire system seizes up.
Like a domino effect.
Exactly. The shock ripples outward, hitting manufacturing, transportation, retail, just compounding the damage at every single step.
So let's take that framework, the unforecastable shock to a highly linked sector, and apply it to right now. Because we are currently living through a textbook example.
We really are.
The U.S. Iran war is now entering its 5th week, and the economic fallout is staggering. Let's look at the raw data on the oil markets. Brent crude has surged 55% just in the month of March.
55% in a month. It's wild.
That is the largest monthly gain since the Brent contract was created back in 1988. It just closed at $112.78 a barrel. And West Texas Intermediate, the U.S. benchmark, settled over $100 a barrel for the first time since mid-2022.
And those prices are a direct, real-time reflection of the immense geopolitical instability right now. Now, just objectively reporting the facts here, President Trump recently stated his preference would be to, quote, take the oil in Iran.
Right.
And the administration has likened this proposed strategy to actions previously taken in Venezuela, where the U.S. moved to effectively isolate and manage the oil sector following actions against Nicolas Maduro.
Yeah, and we're just laying out the policy reality here, regardless of political leanings. The rhetoric is incredibly aggressive. There are explicit threats to obliterate Iran's electric generating plants, their oil wells, and specifically the Kharg Island export hub.
Which is a massive target.
Right, Kharg Island is the jugular of their energy sector. It handles about 90% of Iran's oil exports. And the condition for the U.S. backing off is the immediate reopening of the Strait of Hormuz.
And the conflict is expanding geographically, which is what is truly spooking the commodity markets. Spain has closed its airspace to U.S. planes involved in the conflict, which just complicates logistics.
Wait, Spain actually closed its airspace?
Yeah, they closed it. Meanwhile, Yemen's Houthi movement has escalated their involvement by firing ballistic missiles at Israel. And the major fear among maritime analysts right now is that the Houthis could attempt a complete blockade of the Bab el-Mandeb Strait.
That strait is a massive bottleneck for global trade. It handles between 4 and 5 million barrels of oil every single day. If that gets choked off on top of the Hormuz closure, I mean, the math gets very dark very quickly.
It really does.
We are also seeing peripheral infrastructure targeted. Like a water desalination plant in Kuwait was just attacked. And then in one of those bizarre twists of geopolitical timing, while the Middle East is essentially on fire, a Russian oil tanker carrying 100,000 tons of crude just docked in fuel-starved Cuba.
Right, and that happened just after the U.S. administration softened its stance on the decades-old blockade of Cuba, basically signaling no objection to Russia providing them with energy relief.
Which is wild timing.
It highlights how energy is the ultimate geopolitical bargaining chip. But what's fascinating here is how the global financial markets are digesting this chaos. If you look at European equities, so the Stoxx 600, the FTSE 100 in London, Germany's DAX, they actually closed higher.
That seems entirely counterintuitive. A major war breaks out, energy prices go parabolic, and the stock market goes up. How does that work?
It does seem disconnected from reality until you look at the composition of those indexes. They are heavily weighted with multinational energy and mining conglomerates.
Oh, of course.
Yeah. So when commodity prices skyrocket, the projected earnings for those specific companies explode, pulling the broader index up with them. However, if you look at the European Commission's report on economic sentiment and consumer confidence, those indicators have absolutely plummeted.
So the people are feeling it.
Exactly. We have a glaring divergence. The stock market is celebrating the profit margins of energy companies, while the actual human beings participating in the economy are bracing for impact.
Here's where it gets really interesting. Let's trace how that shock actually travels from a war zone to your living room. We know oil is the first domino, but it's the physical downstream supply chain where the real economic friction happens. Like, two of the largest aluminum producers in the Gulf Emirates, Global Aluminium and Aluminium Bahrain, were recently attacked.
And together they supply about 9% of the world's aluminum.
9%. And aluminum smelting is basically congealed electricity.
It is. It requires a massive, uninterrupted amount of energy. When the energy source is threatened or the physical plant is attacked, the supply drops instantly. Following those attacks, aluminum prices on the London Metal Exchange spiked to a 4-year high.
And aluminum is in everything, from the frame of your car to the laptop you're working on to the framing of commercial buildings. But let's go even further down the chain, past the heavy metals to everyday consumer goods. There is a profound panic happening among Chinese manufacturers right now.
Yes, the reports from Beijing are pretty intense.
We're seeing reports from trade shows where factory owners are aggressively hoarding raw materials.
They're looking at the Strait of Hormuz, they are looking at the price of oil, and they are front-running the inevitable cost increases.
Exactly. Take Davey Wei, a manufacturer who makes pickleball paddles. His paddles rely on polypropylene, which is a plastic directly derived from petrochemicals largely sourced from the Middle East. Because of the supply chain disruption and the rising cost of oil, he is raising his wholesale prices to U.S. buyers by 20%.
20% on a paddle.
Right, and he's openly warning that if the conflict drags on, he might have to double his prices. Another manufacturer, James Lai, is bumping the price of his polyester scarves by 5%. A toy manufacturer named Wang Mingming is stockpiling 2 months' worth of PVC plastic just to ensure his assembly lines don't grind to a halt.
This is the physical manifestation of Goodspeed's linkage theory. A missile in the Middle East disrupts oil flows. That raises the cost of petrochemicals globally. A factory owner in Beijing pays more for polypropylene, so they hike their export prices.
Yep.
And a few weeks later, the pickleball paddle sitting on the shelf at your local sporting goods store is 20% more expensive.
But let me push back on this a bit. Are we overstating the vulnerability of the modern economy to an oil shock? Haven't we spent the last 20 years trying to insulate ourselves from this exact scenario?
It's a fair question.
I mean, we have millions of electric vehicles on the road, massive investments in solar and wind, and the United States is now a massive domestic producer of oil. Are we really still at the mercy of the barrel?
It's a completely valid challenge, and Goodspeed does acknowledge that the structural nature of the economy has changed. We've seen longer periods of expansion between recessions because we are, slightly more resilient. But if we connect this to the bigger picture, energy, specifically fossil fuels, remains the unavoidable base ingredient of the physical world.
Right, it's baked into everything.
Exactly. Even if you drive an EV, the asphalt you drive it on, the plastic in its dashboard, the ships that transported its battery minerals, and the fertilizer used to grow the food at your grocery store are all inextricably linked to the price of oil.
So even if we don't feel it at the gas pump as acutely as we did in the 1970s, we feel it in the price of literally everything else.
Exactly. And when those Chinese suppliers pass on 5% to 20% cost increases across thousands of categories of goods, it acts like a massive tax on the U.S. economy. It reignites inflation. And that traps central banks in a brutal policy dilemma.
Which they hate.
Oh, they do. We are looking at recent commentary from Federal Reserve Governor Stephen Marin, and the anxiety is palpable. If inflation spikes because of an unforecastable geopolitical shock, the Fed is cornered.
Right. What do?
Do they cut interest rates to stimulate a slowing economy that is being crushed by high energy costs? Or do they raise interest rates to kill demand and fight the new wave of inflation coming from those expensive pickleball paddles and polyester scarves?
It's stagflation, the absolute worst-case scenario for monetary policy. So what does this all mean for the person walking out of their front door trying to manage their daily life?
That's the real question.
As these supply chain costs crash onto U.S. shores, how is the average American actually absorbing the impact? The data indicates they aren't absorbing it well at all. They are stretched to the absolute breaking point.
The consumer squeeze is intensifying rapidly, and the most glaring evidence of this is in the auto market. The debt statistics are genuinely alarming. According to Edmunds, 30.5% of car buyers who are trading in a vehicle are currently underwater.
Nearly a third.
Yeah, that means they owe the bank more money for their car than the car is actually worth on the open market. We haven't seen negative equity rates this high since 2022.
And the hole they are in isn't shallow. The average amount of negative equity on those trade-ins is a record-breaking $7,214. Let's unpack the math of how this happened, because it's a perfect storm of bad timing and inflation.
It really is a perfect storm.
The average price of a new car right now is $49,353. That is a staggering 30.3% increase since February of 2020. During the pandemic, supply chains broke down, semiconductor chips vanished, and car prices skyrocketed.
Right.
People bought vehicles at the absolute top of the market, often paying thousands over the sticker price.
And automobiles are historically depreciating assets. So the supply chains eventually normalized. The bloated values of those used cars plummeted back to reality, but the massive inflated loan the consumer signed remained exactly the same.
They're stuck.
They are trapped in an asset that lost its value faster than they could pay down the principal.
So what does a consumer do when they want a new car, but owe $7,000 more than their current car is worth? They don't walk away. They double down. They take that $7,000 of negative equity and they roll it directly into the loan for the new $49,000 car.
Which is terrifying math.
Now they're financing $56,000. And to keep the monthly payment from completely destroying their checking account, they are extending the length of the loan to absurd durations. Over 40% of these underwater buyers are signing 84-month auto loans.
7 years. They are financing a depreciating asset over 7 years just to absorb the negative equity of their previous bad investment.
And even stretched out over 7 years, the average monthly car payment has hit a record $916. People are paying nearly $1,000 a month for a standard commuter vehicle. It is financial quicksand.
It really is.
But as distorted as the auto market is right now, the housing market has managed to achieve an even stranger anomaly. We are seeing a complete inversion of historical real estate norms. For the third consecutive quarter existing, older homes are currently more expensive than brand new homes.
This is a remarkable structural failure of the housing market. If you look at the data from 2010 to 2019, newly built homes historically carried an average premium of about $66,000 over existing homes.
Which makes total sense. New appliances, modern layouts, zero wear and tear.
Exactly. But in the fourth quarter of 2025, the median price for a new single-family home was $405,300, while the median price for an existing home climbed to $414,900.
How does a 30-year-old house with a questionable roof cost more than a brand new house with a warranty?
It's the lock-in effect, driven entirely by interest rates. Millions of homeowners refinanced or bought homes during the pandemic when mortgage rates plunged into the 2% and 3% range.
The golden handcuffs.
Exactly. Today, rates are significantly higher. If those homeowners sell their current house to upgrade or downsize, they have to trade their 3% mortgage for a 7% mortgage. The math is catastrophic for their monthly budget, so they refuse to sell. They are completely locked in.
Which means the supply of existing homes hitting the market is incredibly thin. And when supply plummets, price goes up, even for older inventory.
Exactly. And home builders are looking at this bizarre landscape and having to aggressively adapt. Construction costs, labor, and materials are still high, but they know the consumer is tapped out.
Right.
To keep new homes priced below that $414,000 threshold of existing homes, builders are changing their entire strategy. They are moving operations aggressively to the south, where land acquisition is cheaper and zoning policies are more favorable. They are building on much smaller lots, and the square footage of the houses themselves is shrinking.
We are seeing a profound shift in where growth is actually happening. The National Association of Home Builders reported that single-family construction only grew in what they classify as micro-counties, which are sparsely populated rural areas on the extreme fringes of major metros. Growth there was up 1.6%. Everywhere else, urban cores, established suburbs, single-family construction actually declined. People are being pushed further and further out just to find a price point they can finance.
And for millions of Americans, even the outer fringes are too expensive. Which explains why, for the first time in over 2 years, multifamily housing construction like apartments and condominiums saw growth across every single market classification.
Wow.
The affordability crisis has become so severe that a massive segment of the population has been permanently priced out of the single-family market, forcing developers to pivot back to high-density rentals.
And what about the people who do own those existing homes? They can't afford to move, so they are just staying put and trying to make the best of it. 47% of the U.S. owner-occupied housing stock was built before 1980. The median age of an American house is now 42 years old. Because we spent the decade after the 2008 crash underbuilding, the national housing stock is aging rapidly.
This aging inventory is fueling a massive boom in the remodeling industry. If you can't afford to buy a new house at a 7% interest rate, you take out a home equity line of credit and renovate your 1970s kitchen.
You make do with what you have.
Right. Interestingly, we're also seeing a massive spike in residential demolition permits, which are up 34.2% compared to 2018. In desirable neighborhoods where empty land simply doesn't exist, buyers with capital are buying older, functionally obsolete homes and just bulldozing them to start over.
It paints a vivid picture of a consumer who is fundamentally trapped. They are physically trapped in their aging homes by interest rates, and they are financially trapped in their cars by $7,000 of negative equity. So human nature dictates that when you feel powerless over the big things, you try to claw back control in the margins. You start micromanaging the details, which brings us to the sudden explosion of credit card optimization.
When a household is bleeding $916 a month just to keep a car in the driveway, suddenly a $50 annual fee on a credit card feels like an intolerable insult.
Exactly. We're looking at advice columns from places like CNBC Select, tracking how consumers are radically adjusting their credit habits. There's a case study of a consumer who holds a Chase Sapphire Reserve travel card. The card carries a massive $795 annual fee.
Which is steep.
Very. In a zero-interest rate environment, maybe the perks justify the cost. But today, the consumer wants out. However, they are terrified of canceling the card because it's their oldest line of credit, and closing it would negatively impact their credit score, a score they desperately need to protect if they ever hope to navigate this brutal housing or auto market.
So the points experts are advising them to engage in incredibly specific financial gymnastics. They suggest calling the bank and executing a product downgrade, moving from the $795 reserve card to the Sapphire Preferred for $95, or the Freedom Unlimited, which has no annual fee.
Right.
This specific maneuver preserves the age of the account, protects the credit score, and retains the accumulated reward points without triggering a taxable event or a credit inquiry.
And then, if that consumer still wants to earn travel rewards for specific airlines, say JetBlue, the experts advise them to pivot and open a completely different card, like the Citi Strata Premier or the Wells Fargo Autograph, which offer point transferability without the astronomical upfront fees.
What's fascinating here is the psychological duality of the modern consumer. On one side of the ledger, you have an individual meticulously optimizing their credit utilization, executing strategic downgrades to save exactly $700 a year in bank fees, and guarding their FICO score like a hawk.
Yeah.
On the other side of the ledger, that exact same individual might walk into a dealership tomorrow and sign an 84-month auto loan, rolling thousands of dollars of negative equity forward, mathematically guaranteeing long-term wealth destruction just to solve a short-term transportation need.
It is pure survival economics. The decisions are no longer based on long-term wealth building, they're based entirely on monthly cash flow triage. The classic American dream, the idea that you seamlessly upgrade your house when your family grows and you trade in your car every 5 years for a nicer model, is paralyzed.
And historically, when the consumer base of an economy becomes this paralyzed by structural gridlock and inflation, the government inevitably steps in. Lawmakers attempt to pull macroeconomic levers to engineer relief and unfreeze the system.
Which brings us to the policy intervention. Because lawmakers are absolutely turning the dials right now. But as anyone who has ever read a piece of legislation knows, the headline of a bill rarely matches the reality of the fine print. The fine print dictates who actually gets a lifeline and who gets left treading water. Let's look closely at the tax code.
Well, let's do it.
Now, explicitly reminding everyone, we are neutrally reporting on the mechanics of these policies here without taking any political stance.
Absolutely. The Trump administration recently implemented a sweeping tax package officially titled the One Big Beautiful Bill Act. And the initial data from the IRS indicates that it is altering the tax landscape. The average refund for individual filers so far this season is $3,571, which is a noticeable increase from the previous year.
Okay, let's unpack the specific provisions of this bill, because they are marketed with incredibly catchy slogans, but the mechanical reality of how they work is highly complex. At the foundation, the standard deduction was curionized to $31,500 for married couples filing jointly.
That is a straightforward baseline tax cut that simplifies filing for millions of people. But then we get into the surgical targeted cuts. For instance, the heavily promoted no tax on overtime.
Right.
The intent behind this provision is to incentivize productivity and reward wage earners. It allows certain workers to deduct up to $12,500 for single filers, or a maximum of $25,000 for married joint filers of eligible overtime pay from their taxable income. However, the critical caveat is that it only applies to compensation that is strictly covered under the Fair Labor Standards Act, or FLSA.
Here's where it gets really interesting. No tax on overtime does not mean that if you work an extra 10 hours this week, the money is tax-free. FLSA rules require that you receive at least 1.5 times your normal hourly rate for hours worked over 40 in a week. The data shows that only about 8% of hourly workers and a mere 4% of salaried workers actually receive FLSA-qualified overtime on a regular basis.
Wow.
Independent contractors, gig economy workers, and many salaried managers are completely excluded.
Furthermore, there is an income ceiling. The deduction begins to phase out for joint filers making over $300,000, and the implementation has created a massive administrative friction. For the 2025 tax year, the IRS waived the requirement for employers to officially report this specific overtime income in a dedicated box on the W-2 form.
Wait, so they don't even put it on the form?
Nope. So the burden of proof is entirely on the worker. Taxpayers are having to dig out their final pay stubs of the year, manually calculate their total overtime pay, and then divide it by 3 to figure out the actual premium they earned above their base rate just to claim the deduction.
That's a headache.
It's a significant financial benefit, but the compliance hurdles are steep. We see a similar dynamic with the no tax on tips provision. This allows tipped workers to deduct up to $25,000 of qualified tip income. It's designed to provide relief to service industry workers who have been battered by inflation.
But once again, there is a very specific carve-out in the fine print. The deduction strictly excludes income from what the IRS classifies as specified service trade or businesses, or SSTBs.
This is a crucial distinction. The government wants to help a bartender or a waitress, but they want to prevent high-income professionals from restructuring their compensation to exploit the tax break.
Right, like Wall Street bonuses.
Exactly. So if you receive a tip or a performance bonus in the realm of legal services, financial consulting, accounting, or even the performing arts, it does not qualify. The relief is geofenced entirely around traditional hospitality and personal service roles, and like the overtime rule, it phases out for high earners.
The bill also aggressively targets family and senior demographics. The child tax credit was expanded, raising the maximum payout to $2,200 per child. That is a massive injection of cash for young families. But it comes with a strict new eligibility requirement. At least one parent must now provide a valid Social Security number to claim the credit.
Historically, an individual taxpayer identification number, or ITN, which is often used by undocumented immigrants or certain resident aliens, was sufficient to claim the credit for a qualifying child. The policy change means that while tens of millions of citizen families will see a larger benefit, an estimated 4.5 million children who previously benefited from the credit are now entirely excluded from the system.
Then we have the senior bonus deduction. This allows up to $12,000 to be deducted for married couples aged 65 and older. During the legislative push, this was frequently marketed as a move to eliminate all taxes on Social Security benefits. But the mechanics show it is actually just a flat, standard deduction based on age.
It does not alter the underlying formula of how Social Security income itself is taxed. However, when you combine this new $12,000 bonus with the newly increased standard deduction of $31,500, the mathematical reality is that it effectively shields roughly 88% of all seniors receiving Social Security from paying any federal income tax on those specific benefits.
And it's worth noting that parallel to this tax bill, a separate piece of legislation called the Social Security Fairness Act also passed. This specifically targeted the windfall elimination provision and the government pension offset rules that historically penalize people who had pensions from jobs that didn't pay into Social Security, like many teachers, police officers, and firefighters.
Which is huge for them.
Yeah, the repeal of those provisions is resulting in higher monthly benefit checks and, in some cases, significant retroactive lump sum payments for those retirees.
Returning to the main tax package, there are two final provisions that directly attempt to address the consumer squeeze we discussed earlier: the auto loan interest deduction and the modification of the SALT cap.
Right. The government saw that people are drowning in 84-month car loans, so they introduced no tax on car loan interest. You can now deduct up to $10,000 of interest paid on an auto loan. That sounds like a massive lifeline. But this is where the policy stops being just about tax relief and becomes aggressive industrial policy.
How so?
The deduction only applies to the purchase of new vehicles that underwent final assembly within the United States.
This is a critical limitation. If you bought a used car to save money, you get nothing. If you bought a brand new car, but the final assembly plant was in Mexico, Canada, or Japan, you get nothing. The policy is designed to stimulate domestic auto manufacturing as much as it is to provide consumer relief.
And let's look at the math on that $10,000 cap. Auto loans amortize differently than mortgages. To actually generate $10,000 in purely interest payments in a single tax year, you would need to be financing a vehicle well north of $100,000.
Oh, wow.
Yeah. For the average buyer we talked about earlier, the one financing a $49,000 car at current rates, the actual interest paid in year one is a fraction of that cap. It translates to roughly $750 in actual tax savings. It's helpful, but it doesn't solve the structural problem of negative equity.
Finally, we have to look at the SALT cap. the state and local tax deduction limit. The new legislation temporarily raised this cap from $10,000 to $40,000. To understand why this matters, you have to look at municipal revenue data. According to recent census figures, state and local property tax revenues just surged past $210 billion in the fourth quarter alone. Property taxes now account for over 37% of total state and local tax revenue.
Which means local governments are leaning heavily on homeowners to fund their budgets.
Exactly. By raising the federal deduction cap to $40,000, taxpayers residing in high-tax states, places like New York, New Jersey, or California who own expensive homes, can suddenly deduct a significantly larger portion of their state income and local property taxes from their federal return. Tax analysts expect this specific provision to drive some of the largest increases in refund sizes, though the benefit skews heavily toward higher-earning households who itemize their deductions.
So we have this massive complex web of tax breaks pulling levers to put money back into the economy. But policy is a two-way street. On the flip side of the ledger, for millions of Americans, a massive dormant bill is suddenly coming due.
Yes. Again, purely reporting on the mechanics of the Biden-era and Trump-era policies here without taking a stance. The student loan landscape has shifted dramatically. The Biden-era SAVE plan, which stood for Saving on a Valuable Education, was explicitly designed to lower monthly payments and accelerate loan forgiveness.
Right.
However, after nearly 2 years of intense litigation from a coalition of Republican-led states, a federal appeals court has officially blocked the program.
The 7.5 million borrowers who were enrolled in the SAVE plan have been sitting in a state of administrative forbearance. They haven't been required to make payments while the courts battled it out, but the music has stopped. The Trump administration has officially issued a 90-day deadline, taking effect on July 1, 2026, for those borrowers to exit the paralyzed SAVE plan and select a new repayment option.
The choices available to them fundamentally alter their financial trajectory. They can transition into a newly proposed repayment assistance plan, or RAP. This plan requires borrowers to pay between 1% and 10% of their discretionary earnings for a grueling 30 years before any remaining balance is forgiven.
30 years.
Yeah. Alternatively, they can revert to the standard repayment plan, which amortizes the debt over a fixed 10 to 25-year tier system depending on the total balance.
And if borrower is overwhelmed and simply does nothing?
The Department of Education will automatically migrate them into the standard plan. For the vast majority of borrowers, moving from the income-driven SAVE plan to a fixed standard plan will result in a sudden, significantly higher fixed monthly payment.
This raises an important question about the net effect of government intervention. We're watching these policies collide in real time. A taxpayer might navigate the hurdles to get a $750 tax deduction on their new U.S. assembled car, and maybe they successfully document their overtime pay to lower their adjusted gross income. But if they are one of the 7.5 million people who now have to resume student loan payments on a principal balance that is likely grown by thousands of dollars due to interest capitalizing during the long forbearance, they might actually end up with less discretionary cash flow at the end of the month than they had a year ago. Policy doesn't just solve problems. It redistributes the friction. It creates distinct winners and losers.
And sometimes policy intervention isn't about grand economic restructuring. It's simply about keeping the basic infrastructure of the country functioning. We see a brief note in the reports that President Trump just signed an executive order to mandate pay for TSA workers following a funding shutdown at the Department of Homeland Security.
Which will immediately ease the massive security bottlenecks we've been seeing at major airports. The workers get paid, the lines start moving. But to tie it all the way back to our first point about the unforecastable shock, the airport might be functioning smoothly, but the cost of the airline ticket is still going to skyrocket because the U.S. Iran war is driving the cost of jet fuel into the stratosphere.
The feedback loop is inescapable.
It really is. So if you are a consumer or an investor looking at this landscape, what is your logical move? The traditional systems feel utterly restrictive. You are locked out of the housing market by 7% interest rates. Your car loan is underwater. The tax code requires a CPA to successfully navigate the deductions, and your student loans are back in aggressive repayment. Where do you put your capital to actually build wealth? This brings us to the final piece of the puzzle, the escape to alternatives.
When the traditional avenues of wealth generation, like buying a starter home or investing in standard index funds, fail to outpace inflation, capital becomes desperate. Both massive institutional funds and everyday retail investors begin hunting for alpha.
We want those huge returns.
They are looking for outsized, non-correlated returns, and they are finding them in alternative asset classes. We are witnessing a profound structural shift in what society considers an acceptable, prudent investment.
And the government is actually paving the road for this shift. Let's look at retirement accounts. Following an executive order from the White House, the Labor Department has officially proposed a new rule that would dramatically deregulate 401k plans, allowing them to easily incorporate alternative assets. We're talking about integrating cryptocurrency, private equity funds, and private non-traded real estate directly into the average American's retirement portfolio.
Which represents a massive ideological reversal. During the previous administration, labor regulators issued explicit, stern warnings to employers, strongly discouraging them from offering cryptocurrency in 401ks due to extreme volatility and the prevalence of fraud in the crypto space. They viewed it as a breach of fiduciary duty.
But this new proposed rule completely rewrites that framework. It establishes a legal safe harbor. It shields the plan sponsors, the employers who offer the 401k to their workers, from liability and lawsuits if they choose to include these high-risk assets, provided they evaluate the inclusion based on 6 specific factors.
Those 6 factors are historical performance, fee structures, liquidity, valuation methodologies, benchmarking standards, and the overall complexity of the asset. As long as the employer documents that they reviewed those criteria, they are legally protected.
But the financial advisory community is throwing up massive red flags about this. Josh Brown, the CEO of Ritholtz Wealth Management, came out swinging against this rule. He stated unequivocally that there is, quote, absolutely no chance retail 401k investors will ever get access to the top-tier, high-performing private equity funds.
His argument is rooted in the structural mechanics of private markets. Top-tier private equity funds are notoriously exclusive. They demand massive capital commitments, often locking up funds for a decade or more. A standard retail investor simply doesn't have the buying power or the patience of a sovereign wealth fund or a university endowment.
So, if retail investors demand access to private equity, what do they actually get?
Brown argues they will be sold secondary, subpar funds wrapped in exorbitant management fees. Furthermore, private equity is inherently illiquid. If the broader market crashes and millions of 401k holders suddenly panic and try to cash out, they will discover they can't liquidate their private equity holdings on demand. Retail capital essentially becomes the dumb money exit liquidity for institutional players. It is a valid, pressing concern.
But despite the warnings, the retail demand to access high-growth exclusive opportunities is insatiable. You can see this clearly in the IPO market. SpaceX, arguably the most valuable private company in the world, is currently preparing for what analysts predict will be the largest initial public offering in history. And they are reportedly considering setting aside up to 30% of their total share offering, specifically for retail investors.
Which is highly unusual for an IPO of that magnitude. Typically, the lion's share of an IPO goes to institutional clients, hedge funds, pension funds, high net worth individuals. But Elon Musk has cultivated a massive, intensely loyal retail fan base. By allocating 30% to retail, SpaceX is tapping directly into that populist financial energy.
And the major brokerages are fighting a vicious turf war to be the one to execute those trades. Morgan Stanley's E-Trade platform is currently in advanced talks to lead the retail allocation. If they secure the deal, it would be a massive blow to platforms like Robinhood and SoFi, whose entire business models are built around catering to that exact demographic of retail trader. It shows how traditional Wall Street institutions are aggressively maneuvering to capture the alternative asset retail crowd.
Speaking of Elon Musk, the billionaire backdrop to all of this market movement is genuinely fascinating and occasionally absurd. He is still deeply embroiled in complex legal battles in Delaware concerning his multi-billion-dollar compensation package at Tesla, as well as the governance of his AI startup xAI.
The legal drama recently took a turn that perfectly encapsulates the weirdness of the current era. Judge Kathleen McCormick, the same judge who previously voided Musk's $56 billion pay package, just reassigned his current cases to other judges on the court. Why? Over a LinkedIn emoji.
It sounds trivial, but it has massive corporate governance implications. Musk's legal team filed a formal motion demanding her recusal, accusing her of bias because she allegedly clicked a supportive emoji on a LinkedIn post that was highly critical of Musk's business practices.
Wait, really? An emoji?
Yeah, literally an emoji. She formally denied the recusal motion, stating the click was inadvertent and did not reflect bias. However, she voluntarily reassigned the massive market-moving cases anyway, explicitly to avoid the media circus and prevent the integrity of the court from becoming a distraction.
It is a stark reminder that the trillions of dollars moving through the economy are ultimately governed by human beings, with all their quirks and errors. But Musk's aggressive pivot toward XAI reflects the broader, entirely rational gold rush happening in the artificial intelligence sector. AI is the premier alternative asset class of the decade, and the sheer volume of capital flowing into it is staggering.
The valuation metrics we are seeing are historic. A South Korean startup named Rebellions, which specializes in designing AI inference chips, just raised $400 million in fresh capital. That single funding round vaulted their total valuation to $2.34 billion. They are openly attempting to challenge NVIDIA's dominance in the hardware space.
And the application of AI is moving far beyond just chatbots and data processing. The pharmaceutical giant Eli Lilly recently struck a massive $2.75 billion deal with a biotech firm called In Silico Medicine. The goal is to use advanced generative AI models to discover and design entirely new drugs from scratch.
Which is incredible technology.
The promise is that AI can compress a decade of chemical trial and error into a few months of computation.
The potential upside is practically infinite, which is why capital is flooding the zone. But there are massive, often overlooked liabilities hiding beneath the surface. Legal analysts are pointing to recent court defeats suffered by Meta, the parent company of Facebook, as a glaring warning sign for the entire AI industry.
Meta was penalized heavily for allegedly burying internal research that showed their algorithms and products were causing tangible psychological harm to users.
Exactly. Now, project that legal precedent onto artificial intelligence. If an AI model provides flawed medical advice or discriminates in mortgage lending algorithms or generates deep fakes that cause financial panic, who is liable? If discovery in a lawsuit reveals that an AI company's internal testing predicted these harms, but they released the model anyway to secure venture capital funding, the resulting legal damages could bankrupt the company overnight. The alternative tech space offers generational wealth, but the systemic risk is equally unprecedented.
Which brings us to the final, and frankly, the most surreal alternative asset in our entire stack of reports. If you feel locked out of private equity, and you don't understand the engineering behind AI inference chips, where do you put your money? Let's talk about Pokemon cards.
The speculative trading card market.
Yes. It sounds like a joke, but the economic data is dead serious. We are looking at analytics from a valuation platform called Card Ladder, which tracks the sales history of graded collectibles. Their data shows that an index of rare Pokemon cards has literally outperformed the historical average return of the S&P 500 over the last several years. During the initial pandemic boom and surging again in 2025, the ROI on pristine cardboard crushed traditional equities.
The scale of the capital involved is what forces traditional economists to pay attention. The influencer Logan Paul recently facilitated the sale of a PSA 10 graded Pikachu Illustrator card, widely considered the holy grail of the hobby, through golden auctions. The final price tag was over $16 million.
$16 million. For a piece of foil cardboard with a drawing of a cartoon mouse. And it's not just a few eccentric billionaires trading trophies. The broader market is booming. Overall, consumer spending on non-sports trading cards jumped 350% between 2020 and 2025. People are literally digging through their childhood closets, sending 20-year-old binders to grading companies, hoping they are sitting on a lottery ticket that can pay off their student loans or fund a down payment on a house.
What's fascinating here is what this trend says about the psychology of the modern economy. It is the ultimate democratization of risk. Because everyday people look at the traditional avenues of wealth building and realize the math no longer works for them. They can't afford a starter home at 7%, their wages aren't keeping pace with grocery inflation, their standard 401k feels sluggish, so they consciously pivot to higher risk, high reward alternative assets.
It's entirely rational behavior disguised as irrational speculation. Whether consumers demanding that their employer put Bitcoin into their retirement account, begging a brokerage for a tiny allocation of the SpaceX IPO, or carefully storing a holographic Charizard card in a fireproof safe because they view it as a more reliable store of value than a treasury bond, it is all born from the exact same macroeconomic pressure.
It is the final stage of adaptation to the economic shock. When the foundation of the economy shakes, capital flows to the fringes.
Let's bring this all together. We started today's deep dive by looking at an economy that was abruptly knocked off its axis. A sudden, unforecastable geopolitical shock in the Middle East, the escalating U.S. Iran war, and the threat to critical maritime straits drove the price of oil to record monthly gains. We traced how that energy shock traveled physically through the global supply chain, crippling aluminum smelters in the Gulf, forcing plastic manufacturers in China to hoard materials, and eventually landing squarely on the American consumer in the form of a 20% price hike on everyday retail goods.
We then examine how that consumer, already battered by years of inflation, is absorbing the blow. We found a society squeezed to the breaking point, tracked by $7,000 of negative equity in their cars, financially paralyzed by a housing market where obsolete homes cost more than new construction, and reduced to micromanaging credit card fees just to maintain monthly cash flow.
From there, we watched the government attempt to legislate a fix. The administration pushed through a complex, friction-heavy web of targeted tax cuts dangling relief for overtime, tips, and domestically assembled autos, while simultaneously, the judicial system dismantled the SEV plan, forcing 7.5 million borrowers back into the harsh reality of student loan repayment.
And finally, we witnessed the societal adaptation. Seeking an escape velocity from this structural gridlock, both massive institutional funds and everyday retail investors are pouring billions of dollars into alternative assets, from private equity and AO startups to the speculative frenzy of $16 million Pokemon cards.
It is a wild, complex, and highly unpredictable economic ecosystem. And as we wrap up, I want to leave you, the listener, with a final provocative thought to mull over the next time you look at your portfolio or the next time you hear a news alert about a conflict overseas.
If alternative, highly volatile, and largely illiquid assets like cryptocurrency, opaque private equity funds, and speculative collectibles become the mainstream, foundational staples of the average American's retirement account, what happens to the global economy when the next unforecastable shock hits? If an oil crisis in the Middle East can disrupt the traditional stock market today, what will a similar geopolitical shock do tomorrow to a 401k that is heavily backed by Bitcoin and Pikachu cards? Will these new safe harbors actually provide shelter, or has we permanently changed the very definition of financial risk?
It's a question that challenges the entire premise of how we build and protect wealth in the modern era. Thank you so much for joining us on this deep dive into the economics of shock and adaptation. Keep analyzing the data, keep questioning the world around you, and we'll see you next time.